Before I turn it over to Crucial Consulting and our colleague Mike Miller to present performance over the last quarter and some updates, I wanted to share some important news from the VCF, and some of you may have already heard this. But our longtime colleague and Chief Financial Officer, Deb Dabrowski, has stepped down to take a position in finance at Porter Medical Center down in Middlebury. Deb has been a long-time member of the VCF family. We're sorry to see her go, and we're going to miss her as a colleague. She's been a great partner and an important voice in this work, the work of community philanthropy in Vermont for roughly 16 years at the VCF. We have a search ongoing. Anna Grady, who's our new VP for operations at the management team level, is working closely with Gallagher Flynn to coordinate the search for a new chief financial officer and VP for finance. And that position will be building on the strong base of financial operations that Deb has built over the course of many years. During the interim, we have partnered with a firm called known as Ascend Financial to provide interim CFO and financial operating support to help beef up our finance team and support the team for the interim period. The team members from Ascend are Scott Smith and Leslie Thayer. Scott has more than 20 years experience in the finance field, served as a CFO for a number of Vermont companies, Vermont Teddy Bear, Hubbard and Forge, and others. And Leslie's background is in the nonprofit sector, includes work in operations, HR, and as a controller. She was most recently the controller at Vermont Legal Aid for a number of years. So both of those folks had time to spend with Deb in advance of the transition. So we feel very good about the framework we have and the progress we're making and navigating a transition to a key position in an institution like ours. So I wanted to share that news and it's worth taking a moment to, recognize that Deb's transition happened between our investment committee cycles, but it's worth acknowledging that 16 years of impact that she had for the organization and the work that she did for Vermont communities as a financial steward of this organization over so many years. So with that, I'll turn it over to Mike Miller from Crucial to get into the deck and the update on our investment performance.
Thanks, Dan, and good afternoon, everyone. It is nice to see many of your faces, maybe someday in person again, but let's start with the portfolio. As you might guess, I will provide some updates as to what's going on in 2022. It's been an interesting start to the year, and I'll tell you one that, by the way, is very much consistent with the way we see the world. So we're not actually particularly upset about what's going on in the markets, but they're certainly getting more complicated and more volatile. So the results here give you a good sense of where the portfolio of the three pools, have performed over a variety of time periods, as you can see on this table. So just to kind of start with the short term, and then we'll move our way along here. Basically, as you can see, the long-term pool finished the year, actually didn't really finish the year, I'll come back to that in a second, but it was up 11.7% as of the date of this report, just slightly ahead of its benchmark. Our value and our non-US biases have been a bit painful over the last few years. So while the absolute return of 12.7% is quite satisfying, the relative return is not. And that those 2 years in between years 1 and 3 have dragged down our 5-year return to be just below the benchmark, but have not really done much damage to the 10, 15-year and the since Crucial was hired period that started in 2002. The SR pools fared better, both in absolute and relative terms over this period of time. We'll talk a bit more about that in a minute and why that is the case. And the midterm pool also, which is largely an index pool with, by the way, a little less risk of rising interest rates in it. So it's been underperforming in part because of rising rates. Rates didn't rise until recently. And so now it's starting to, as you might guess, you'll start to see that in 2022, a reversal of what you see here. I made a comment earlier that the long-term pool's results aren't finalized. And the reason I said that is because there's a meaningful but not dominant piece of that portfolio that's in private equity funds. And those funds don't report their results. Really, they start reporting around now. And so we don't have those numbers yet. My guess is that 11.7 will go up. I don't want to speculate as to how much, but it will go up and therefore increase the lead you see here. And I assume it'll get above 12% once all is said and done. It could be even higher than that. So we're pretty optimistic about what those numbers will look like. So one thing, of course, that you get into on a regular basis is the difference in these pools, particularly the long-term pool and the socially responsible pool and their performance. And then also the degree to which you build a portfolio that's different than your benchmark. And different is good when you're ahead, and it's not so good when you're behind. And so I want to talk a little bit about why we do build different portfolios and what we expect to get from that and what we expect to deliver to you from that. And that's where we get to this page, which focuses on the long-term pool because the track record is longer. And it's the same, these are actually not the same numbers you saw before. These numbers are per year, and these numbers are cumulative, and obviously it's converted the graphical form to make them a little more impactful. And so cumulative means just, essentially simplified. It's not really that way. The math doesn't work this way, but multiply that out based times the number of years is the basic way to do it, but it's compounding, so it's a little different than that. But the key point here I want to emphasize is really a few things. So one is the 3-year number, which, again, let's go back for a second. 12.7, you should have had 14.1, disappointing. And you can see that converts to 43% gains for the pool versus 48.5, still disappointing, by the way. But when you start to put that in context of the longer term results and the 133% gain versus 123 for the benchmark for 10 years, and since April 2002, the as you can see, 336% gain compared to 247% for the benchmark, it all starts to be a little less disconcerting. And what I would tell you is we do build portfolios that are out of sync with what's popular in the markets at certain moments in time, because we feel that popularity is the enemy of long-term performance. If everybody likes an idea, it's probably not that great of an idea. Those are the lessons that markets teach, and they're actually starting to teach that lesson again here in 2022, with unfortunately a lot more to come. And we will talk about that. Unfortunately, that's going to be my pessimistic side of today's presentation. There's an optimistic side to it, I promise. So that's what you see here, and I want to just emphasize the thing that really drives us, which is when you look at the last 10 years. One thing you'd say, so thankfully, I'm glad to say the Community Foundation long-term pool's performance exceeded its benchmark, the 133.5 versus 123, but they both exceeded CPI plus 5%. So both were very good philanthropic portfolios, and let's be clear about that. That's important. But now take a look at, the since 2002 period first, for the other arrow points. So in that case, owning the indexes, again, weighted as our asset allocation strategy is weighted, just to be clear. So we mimic the long-term pool benchmark, as do the other benchmarks, are weighted based on the strategic mix of the pools. But so in that scenario, though, the pool's benchmark fell short of the orange bars. So the orange bars are CPI plus 5%, which is basically the definition of preserving purchasing power of your funds and other funds that are in the pool. And that 246 versus 317 is a terrible, terrible outcome for the index. The pool, though, because it had so much outperformance, managed to preserve, in fact, enhance its purchasing power since 2002. And so when you look at that set of bars, and we'll come back to the 15 years in a minute, that tells you the story as to why we're willing to be different. To exceed the benchmark by that much, you need to be different than it. Sometimes you're not going to be, we don't do timing. So we'll be early, but we're not wrong. And that's what you're seeing over the last few years, frankly, in our opinion, but that's changing before our very eyes today. Now look at 15 years for a second, where it's the same story, where the index is way behind CPI plus 5, but the pool is not. It's behind, but not by as much. And our point here would be that if you stay in the game, the 180 versus 192, and we can make that up. 133 to 192 can be made up as well, but it takes a lot longer to do it. And so we need to actually keep our eye focused on keeping those blue bars ahead of the red bars ahead of the orange bars as much as possible. That's the key thing we're doing, which leads to one more thing, because we're going to talk about this a little bit today. Take a look at CPI plus 5 for the last year on this page. Didn't need to tell anybody in this call, I'm sure, that we have inflation in this country right now. And we'll talk about that a little bit later. And that's made this benchmark much tougher than it's been in a while. And that's the curse coming to the traditional investors that are out there. And the foundation has a nice advantage, which I'll talk about in a second. So I mentioned before that the long-term pool has fallen short over the last few years of the socially responsible pool. And there really are a few reasons for that. One is a socially responsible pool is a little more growthy. So when you screen portfolios for environmental factors and others, you tend to end up with a little bit more of a growth-oriented portfolio. We also use more index funds in the socially responsible pool currently, although that will change over time. We'll still use them, but not to the same degree. And those things have come together to create these differences. So the way you read this graph is this goes back in time and says, well, what were all the sub periods along the way? Because one of the risks you have, let me go back for a second. When you look at this page, let's pretend the 15 years isn't on here. You see 8.9% compared to 9.4%. So I'm comparing the long-term pool's return to the socially responsible pool's return. You see that and you say, well, the long-term pool hasn't outperformed in 10 years. And that's actually not what happened. There was a lot of sub periods along the way. So this graph looks at rolling 5-year periods ending each and every month back from the beginning of the SR pool in 2006 until the end of the year, essentially. So we use this zero line, which represents just a simple 60-40 mix of stocks and bonds. And when the lines are above the black line, that means they're outperforming 60-40. But the point of this graph isn't really that. The point is to show you how the performance differs between the two pools. So there was a period, it was a while ago now, but not that many years ago, in the left-hand side of the graph, where the long-term pool dominated the socially responsible, it had much better returns. It was significantly different. In fact, it was a little disappointing to everyone at the Vermont Community Foundation because the SR pool was underperforming the 60-40 as well as its own the pool. And what we really want to see, what you see in the middle of the graph is what you've got, which is the two pools are neck and neck, because they're both, by the way, very good pools, just to be clear. And they're both ahead of a simple 60-40 mix. Now, what's happened is you can see this big giant drop off for the long-term pool was essentially the COVID crisis, hitting it harder because it has a lot more value-oriented securities, which really took a beating when the world shut down. Then you can see it sat there for a little while, then it came roaring back, although still not as good as the socially responsible pool, which is fine with us because socially responsible is doing very well. And then it plunged again. And this last plunge is just the fourth quarter of 2021, which is, we would argue, is the last gasp of grossly overvalued large tech and consumer names because it's reversing as we speak. And so we expect to see that blue line come back up. But the real point of this graph is that the returns are very different depending on when you look. And so you have to be very careful not to assume that because a pool's underperforming, that it will always underperform, and you have to recognize the cyclicality of investment returns. I think the greatest mistake people make as investors is they fail to appreciate that things are all cyclical, and that's the challenge we face every day. So the strategy that generated these returns over time is a very simple one, and it becomes very important at times like this. So first thing, think long-term. So the investment committee today is going to be discussing the strategic mix of all three pools, by the way. And there may be changes, there may not. I will report back to you at a future meeting about what the committee decides. And as will Dan and the rest of the team, of course. The second point is we don't try to figure out what market's going to do in the short term. So while we think that a lot of the large S&P 500 companies should be trading 30 to 50% lower than their current prices, we have no idea how that's going to unfold. It could unfold over a year, it could unfold over 10 years, and it could unfold just by having the companies grow and produce very small rates of return, which is the most desirable outcome that can happen to an investor in those types of companies. And last but not least, though, if you don't know what's going to happen, which we don't, at least not short term, you need to diversify your portfolio. So think long term. Do not get tempted by short-term ideas and short-term predictions. I'll tell you the most popular idea I hear everywhere today is that interest rates are definitely going to rise. We actually tend to think that is probable, but the idea that we know with certainty about anything is a mistake. We don't know what's going to happen, although we can always think that the odds are what they are. And I'll talk about that as well in a second. So here are the strategic mixes currently of the three pools. And you can see that the long-term pool has just under 60% of its assets in equities. The socially responsible does have 60. And then the midterm pool has 47.5%. Special opportunities, because that's not a label most people are familiar with, is another type of equity strategy. It's one where the portfolio is allocated to very specialist managers. Somebody's involved just in biotechnology companies, for example, or just in Japan, or some other types of very niche type strategies. We use those because they're very different than the broad indexes. And so they create a diversification benefit. Most of the time they help performance, not all the time, but nevertheless, that's why they're there. And it's part of the secret sauce, I would argue, behind having hundreds of millions of dollars to invest as the Vermont Community Foundation does. It's the beauty of pooling capital is access to investors that frankly are amongst the best in the world and produce outcomes that reflect that fact. So the other point I make is you'll see the portfolios are very long-term oriented. 58.5% in stocks for the long-term pool, plus 17% in alternatives. So that's a big chunk of assets that are basically exposed to market volatility, but also generate high returns, which you saw on the earlier pages. The last point to make on these first two columns is the bond portfolios. Now you'll see they're quite a bit different in the sense that the long-term pool has a lot more diversification and has less in bonds. And that's because it can use things like hedge funds and private assets to dampen the volatility to a larger extent. But the socially responsible pool has had a solid bond allocation, which the committee, by the way, today will be discussing. We'll see where they fall out on that. And then at the bottom, you'll see the Vermont investments are 5% of all the pools. Those have been a wonderful, wonderful part of the Vermont Community Foundation's investing and mission-aligned investing, and at the same time have added diversification to the overall pool. So we think those are a complete win-win. And then finally on this page, I'm going to take a pause and see if anyone has any questions they'd like to throw out before I move on. You can see here that the midterm pool is essentially, we would argue, is a 50-50 pool. So the 5% in Vermont, and then what's left is split evenly between stocks and bonds. The reason the midterm pool has more bonds is because it's meant for a midterm philanthropic time horizon. So if you're granting out capital from your fund over 4, 5, 6 years, the long-term pool is too volatile, as is the socially responsible pool. You should be in a shorter, less volatile portfolio, which is what the midterm pool reflects. Are there any questions so far? Okay. So let me talk for a second about managers. Oh yeah, was there a question? Yes.
Yeah, this is Ron Millard from the Vermont Woodlands Association.
Hey.
What fraction of the total investment pool is in each of the sub pools?
Oh, that's an excellent question. So I would tell you, bear with me a second. I'm sorry, let's stop sharing because I'll end up sharing something I shouldn't. I have a bad habit of doing that. Bear with me one second. I can answer that question. Here it is. Let me just get to the page I want to add. So basically, bear with me, almost there. So I would tell you that of all the funds, currently about 60% is in the long-term pool. And then another, I'm looking sideways because that's my screen's direction. Another 30% plus is in the, actually closer to, 30% plus is in the socially responsible pool. Bear with me one more second to make sure I don't give you anything that's incorrect. And then I might have to revise one of those numbers for you. Give me 1 second, make sure. Oh, yeah. Sorry. So 60% is from the long-term pool, sorry. Close to just under 40% is actually the SR pool. Dan's nodding. Thank you, Dan. I'm sorry for getting that wrong. And a very tiny amounts in the midterm pool today. So it's basically 60-40. The midterm pool is almost too small to think of, Ron.
Well, there are two big factors behind that, Ron, is, in terms of donor selection over the last 5 years, we've seen, a spike and increase in the socially responsible pool. A lot of incoming funds are selecting into that SR pool. Additionally, we made a strategic decision a year or two ago to begin migrating our discretionary funds, the funds that are that power the VCF's community impact programming, from the long-term pool into the socially responsible pool. As a part of the exercise of just sort of affirming a broad commitment to our mission and the values-oriented impact related to the management of the resources that we have to steward. So that's driven the growth of the SR pool over the last few years.
Thanks, Dan. Any other questions so far? Okay. So I showed you earlier on that the pools, I'll go back for a second just so you can see this, that the pools, generally speaking, over time are outperforming their benchmarks, which leads to one of the classic questions, which conveniently for us is not as hard as it can be elsewhere, which is, why use active management? Because we do use active management. We use passive management and active management. The advantage of passive, of course, is it's less expensive. It's predictable. It's going to give you whatever the market gives you if it's done right, which usually it is. And active is got its own set of risks that associated with it. We think this might be one of those moments in time where a very small percentage of active managers add an unusually large amount of value. So that longer term record you saw for the long-term pool, we think probably is more relevant today than at any other time I can think of in the last 5 years. But let's just talk for a second about how we think you go about finding those very small percentage of managers that can do that kind of work and produce those kinds of outcomes. So the Crucial team today is 71 people in total, 27 of whom are on the investment team, and about 17 of them are responsible for finding and keeping track of all the managers in the portfolio. I'm chief investment officer, so they all ultimately report to me. So I'm intimately involved with how we go about doing the research and what we ultimately bring to the clients and bring to the investment committee and Dan here at the Community Foundation. So if you were at Crucial, the 4 basic rules that we teach you on day one. Rule 1, returns are always accompanied by risk. So if somebody has a great return or you think it has a great return, it has risks. And the goal isn't to find investments without risk, because that doesn't really exist in the real world. The goal is to understand the risks that are being taken and to do so and pursue them with the knowledge of whether you can tolerate the downside scenarios or you can't. And if you can, then maybe it's a good idea and maybe it's not, but you have to get paid for the risks you take. It's a question of analyzing risk and analyzing return. Second point, you can't analyze active managers by reading about them. You need to know them. So we spend a lot of time, and we used to spend a lot of time on the road, and we are again now slowly, because you need to be in people's offices wherever they sit around the world and making sure that they are as good as you think they are, and then essentially interviewing them constantly. And so that's what we spend a lot of time on. If we can't understand how somebody makes decisions, then we're not interested. There needs to be a thoughtful process that is transparent and easily understood. Third point, a place where we do not take risk under any conditions is operationally. So each fund has to have an independent custodian, a credible auditor, an outside administrator. This is the Bernie Madoff issues that you're avoiding with these scenarios. So we have a team of 3 people right now at Crucial whose job it is to do what we call ODD, which is operational due diligence. So they're verifying everything on a fairly constant basis, particularly for new managers. And then every year we do updates, whether there's the service providers and all the cash controls and everything else are still in place as they should be. And then last but not least, this is something the investment committee and Dan have been particularly good at because it's hard to do, which is to make it a forward-looking process. So it's easy to look at a piece of paper and say, oh, this manager did well, they must be good. This manager did badly, they must be bad. The problem with that is it ignores the fact there's cycles. And I will tell you, for example, up until this year, anybody who owned a tech stock looked brilliant. Doesn't mean they were brilliant. And anybody who owned banks or cyclicals looked like a moron, and that doesn't mean they were morons. And so our job, and then the investment committees and Dan's by extension, is to try to ferret out the difference. And the numbers don't tell the story sometimes. And that's why all the depth that goes into everything else is so important. And when the investment committee reviews an investment or we discuss an investment, it's usually not about the returns. It's usually about what's going on at this firm. What kind of people are these? What kind of decisions do they make? What do they own? And they get investment committee members are big readers because they get very long reports that they are asked to go through, and they do amazingly well, and they make it not hard. They keep Pete Mitzos, who's my partner here on the Community Foundation account, and I in check when it comes to doing our work right and knowing what we're doing. So I'm not going to spend any time on this. This is just the beginnings of the list of things that an analyst at Crucial has to look at, and there is. I wish I revised this page because it's missing about half the stuff we do, but nevertheless, that's just a quick thumbnail sketch of that. So let's turn our attention out of probably something that everyone will find a little more interesting, at least currently, which is what is going on in the world right now, and what do you think is going to happen, or what do we think is going to happen to markets and to investments. And as I mentioned earlier, we don't have any short-term forecasting tools, and we know we're not good at it. We don't think anybody is, frankly, and we're certainly not invested or interested in playing the lottery ticket of making guesses and hoping one of them gets right. That's kind of what Wall Street strategists do for a living. We don't do that. We need to get this right all the time, as much as the time we can. And when we're not getting it right, that's a problem. And we don't assume knowledge we don't have. With that said, you can't ignore what's going on in the world right now, because it's something big is happening beyond COVID, believe it or not, and that's about interest rates, inflation, and central bank policy. So let's spend a minute or two on this. So first of all, obviously, inflation's rising, and the key question is, or it's risen. The key question is it sustainable or not? And our answer is yes, but not as much as you're seeing today. It should come back down to some degree. So we're not, and we do 10-year forecasts, just to be clear, and we're not forecasting 7% inflation. In fact, we're forecasting 2.75% for the next decade, which may not sound like that much given that we're in a 7 to 7.5% inflation regime today. But the reality is that some of that 7.5 is COVID opening / disruption related. Some of it's structural. And we respect the power of the Fed to have some influence on this, which has its own set of issues. The second point, and this is what's so disconcerting, I would not be able to sleep at night if these were my choices, but you've got very low interest rates that make no sense, given even our 2.75% inflation rate. And equity index prices like the S&P 500, for example, and the All Country World Index are trading at nosebleed prices. And that should be very disconcerting for long-term investors. Third point, and the fourth point go together. These were on our last few slide decks. We went back and looked at the last few quarters. The only difference between these 2 points is the last point didn't say market speculation was frightening. It said market speculation is frightening. And definitely not to pick on anybody, but the kind of the poster child for market speculation in terms of publicity are the ARK funds. And if you watch what's happened to those funds over the last 6 months or so and the collapse in price, that's a sign of basically some of the speculation drifting out of the markets right now, because that's unfortunately had to happen, sadly, for people invested. And unfortunately, same thing is going to have to happen in a very different way for some of the indexes that we're most worried about today. It's just a matter of time. So let's start with interest rates and inflation. So this is for those of you who don't like bad news. This is the bad news segment of the presentation. There's a better news part coming, I promise. But what we want to talk about a little bit is why are interest rates as low as they are if inflation is as high as it is? And so just to give you the nomenclature that we use. So if interest rates are currently about 1.9 to 2% in the United States, 10-year treasury rates, and inflation is running 7 or 7.5%. That means that something we call the real rate, which is you take the rate of return, the rate yield on a bond, and you subtract inflation, and you get a number that's really around negative 5% today. That's a negative real return. That's very bad news, as everyone knows on this call. I didn't tell you that. So fascinating issue. And you might say there are a couple things that are happening that get behind that. So one would be that inflation is going to come right back down. It's going to go all the way right back down to the 1.8, 1.7, 1.6% rates we've been seeing for most of the last 15 years. That's one scenario. It seems highly unlikely to us, given what's going on in the world. I don't think anyone needs to really be given a whole long dissertation on the fact that labor clearly has more power right now. Commodity prices are clearly rising. There's all kinds of geopolitical problems that are basically not great for trade. COVID, et cetera, et cetera. You know, the idea that inflation is coming all the way back down seems improbable, but never say never. Second scenario, though, is the bond market just has this wrong, and that markets are all creatures of momentum and recency bias. So recency bias in English means that when we live our lives to a certain extent, we assume that the condition we're in currently will continue on. And markets are constantly expressing this idea in different ways. It's why the S&P 500 continues to trade at such high prices, because it's been very successful for a while and people get very comfortable with it. Same thing in the bond market. You have been perfectly happy to own bonds for quite some time during the era of quantitative easing and Fed policy. So there's a comfort factor. So is that possible? And the answer is we think it's extremely possible. In fact, it's the most likely explanation for this. And to show you an illustration of this historically, we came up with this chart. So this chart goes back, this is not current. The dates in the bottom are correct. This chart starts in 1970 and runs through mid-1984. This, by the way, was the last time we had really sustained inflation in the United States. As my 2.75% number from earlier suggests, we actually don't think we're going back to this kind of era, but again, never say never. So the blue line reflects the yield on the 10-year treasury. So as a reminder, that yield today is just around 2%. The gray line is rolling inflation over the period of 1970, so rolling 1-year inflation. So as you watch that gray line, it cycles and cycles, and the blue line sort of sits at a certain level, gradually rising as inflation rises over time. But look at the far right-hand side of the graph. That's the important part of this graph. And look at the way that inflation plunges. That's the Volcker years. And what we can now say, because we have the certainty of knowing what happened, because we're sitting here in 2022, that was it. Inflation was really kind of dead now for us for a very long period of time. And that's what that gray line plunging reflects. But the blue line, look what it does. It doesn't move. Why didn't it move at the time? two theories, again, just the opposite today. One is similar, one's different. One is inflation is going to come back up. That's the recency bias again, right? Because it always had before, at least for the last 14 years. So it's going to do it again, but it didn't. Now we know. So essentially, the bond market had it very, very wrong back then. And it's the same story in reverse today. People think they know what's going to happen, at least in the bond market. They think there's safety in owning these bonds, longer term bonds, and inflation just won't be a problem because it's illogical for anybody to own a bond with a negative 5% real return. That just doesn't make any sense. And so this is a huge risk, though, for investment portfolios, because the process of what did have to happen, the blue line had to plunge eventually, right? That's what happened if I kept drawing the graph later. So if you flip these lines over on their head, the gray lines now rise and the blue line's way at the bottom. The blue line has to go up. And as that blue line goes up, you're going to lose money on bonds. And it could be a lot, it could be a little, who's to say for sure, but it's not good news for long-term investors. So one question always that comes up, and this is where, by the way, we get ourselves into more trouble than any other thing we do. We have these very long-term views, and we're completely ignorant about the short term. So we advise our clients, and it usually is very wise at the end, but not wise always along the way, to get ready for what's going to happen in terms of markets and valuations. But if you're there early, you don't look so good for a little while. And that was those 3-year numbers I showed you earlier for the long-term pool. So we're always worried about what is going to give us change, or the market's going to ever figure this out. So this graph just gives you a little sense that something really big is happening out there. So what this graph is looking at is the amount of global negative yielding debt. And what that means in English is those are not negative real returns. Those are actual negative interest rates. We had them in Germany, we had them in Japan, we had them in Switzerland. We had a whole bunch of places, mostly Europe and Japan, that had negative rates. And just for those who don't think about bonds all day, a negative rate's even weirder than a negative real rate. A negative rate means that I decide to lend Dan some money, and I have to pay Dan to take my money. That's a negative rate of return, which makes literally no sense. And I'm sure Dan and I would, well, one of us would be very happy with that arrangement, the other one not so much. But the point is, that's what a negative rate is I have to actually pay you to take my money from me and use it for your own purposes. They have to repay it, of course, still. But the point is, that's what a negative bond is, a negative yield is. And look at this graph. It's plunging here to 4.8, still $4.8 trillion of negative yielding debt in the world, but that's way down from the 18.3 or $17 trillion levels we were seeing not that long ago. And the graph just tells a really interesting picture about how much things are changing as we speak. So sorry, I'm just looking at the text. So let me move on. So unfortunately, the problem doesn't stop at the bond market of so much cash, so much recency bias, so much lack of nervousness about valuation. So let's talk about the S&P 500, which is a very big part of a lot of portfolios, and we have exposure to it at the Community Foundation as well. Just to be clear, it's not something you just ignore or avoid. So what this graph does, or chart does, or table does, excuse me, is it looks at something called the Shiller ratio. So for those of you on these calls before, you've heard this before, but let me do it one more time if you don't mind, and I will make it quick. A Shiller ratio takes the last 10 years' earnings and adjusts them for inflation and averages them, and then takes the price in the market today, divides it by that earnings number, and you get a ratio. So that's that first column with the different ratios, everything from 4.8 to 45. So Bob Shiller, very kindly, he's a professor at Yale, there's a data set. You can download it from his website or his FTP, and you can download the data set. And we did that. And we said, I think it goes back to the 1880s. So we downloaded every single month back to whatever, or however far back he goes, and we put them in these buckets. So that's what the number of observations is in the second numerical column. So that's where all these numbers fit over time. So the first thing that should grab you is the yellow shaded bar. That's where the S&P sits today. It's at about 36, 37, depending on when you look right now. So it's solidly in that second from the top range. So first thing that grabbed me at least was, wow, it's only been that high 34 times in history. And you can see how many, there's literally 1,300 observations here. So that tells you something about the rarefied air we're living in today. And the second thing, and this is something that really is fundamental to investing, but completely useless over short periods of time, which is that what you pay for an investment matters. It's not important for the year or two or three. Sometimes markets can defy gravity, like I showed with the bond market earlier, for quite a long time, but they can't defy it forever. Eventually it works. So take a look at the far right-hand column. What these numbers reflect is what was the return for the next decade from each starting Shiller ratio. So if the Shiller ratio was 20 in, I'm making up a number, let's say it was 20 in 1963. So what did the S&P 500 do from 1963 to 1972? What was its return? So we did that math too for every single data point. And then we calculated the median for all these buckets. And take a look at it. It's exactly what it should look like. I did my master's degree in statistics, and one of the things you learn as anyone takes a statistics course is there's something called correlation without causation. There's an old study that proved that there was more consumption of color television sets in areas with a larger number of visually impaired people. Clearly, causation, no correlation without causation. Obviously, the visually impaired people don't care whether the TVs are black and white or color. The fact is that that's the opposite. This makes sense. You pay more for something, you get less in the future. You pay less, you get more in the future. So look at the bottom. The price earnings ratio less than 10, you had a 15% annualized return from that point forward. If it was between 10 and 15, you had a 12%, I'm rounding, annualized return, all the way up to the top. And you see the way the numbers generally head downward, and it makes perfect sense for the reason I just said. This is correlation with causation, because this is exactly how things should happen. Now focus on that yellow bar. We also gave you the best 10-year period and the worst 10-year period for each of these different areas. And what's fascinating is the median is 2.6% per year. That includes dividends, by the way, for the S&P 500 from this point forward. And the best, if you want to be an optimist, is 4.7% per year. So let's even go further. Let's say that the S&P can do 5.5. 5.5 from S&P and maybe 1 or 2, if you're lucky, from bonds is a very hard way to get to CPI plus 5, particularly if the CPI itself is 2.5 to 3%. So this is what worries us. This is what is very nerve-wracking for philanthropy, generally speaking, and just overall well-being of people who are invested in the markets. It's a huge, huge concern that really everybody has to address. But let me give you one more data point, because this is the short-term, long-term point. So the correlation, sorry for correlation all day, guys, but correlation between the S&P 500's Shiller ratio and its forward 10-year returns inverted is almost 0.7, which is an extremely high correlation. The correlation between the S&P 500 Shiller ratio and its 1-year forward return is 0, which is exactly what that number suggests. It's meaningless. So can the S&P 500 go up 30% again this year? Sure. Can it do it for 2 more years? Absolutely. Can it do it for 10? I guess it could, but that's a huge bet against history. And I don't think that's a prudent way to manage anyone's finances. It's certainly not a prudent way to think about philanthropy in Vermont, that we're going to bet that what's happened in the past is meaningless, because that's a huge mistake, especially because it's probably not meaningless. Sorry for the long-winded diatribe on that. I'll be very quick on these last few slides because we have plenty of time for questions. So why does my wife keep telling me to stop smiling so much? We love these markets. And my wife tells me I should stop smiling because I come off as cold and heartless and have absolutely no concern for my fellow human beings who might be losing money in these markets. And I'm not a terrible person, I promise. But we're smiling because the kind of conditions we're in now are exactly out of the playbook for how the Vermont Community Foundation generates above market returns and above CPI plus 5% returns. And it starts with 2 basic ideas, 3 basic ideas. The first one is that the people who manage money for the foundation are extremely good at assessing businesses, assessing the risks of those businesses, and assessing what they should be trading for. What's the price that's reasonable for a stock? Markets don't do that. And they particularly do a bad job of it at times when you've got COVID and all kinds of things going on like we have today. So what this graph is looking at is the spread of what we call valuations across the S&P 500. So as the footnote says, this is from the 20th percentile, i.e. 20% of the companies actually had lower valuations than this, and 20% also had higher valuations. This captures, basically that midsection plus of valuation. Look how wide the gray is on the right-hand side of the page. That's our playground, essentially, which is the stuff at the top, stay away from for the most part. The stuff at the bottom, which is a lot of companies as well, that's where we love to be. And this spread has to narrow. And the way it usually happens, and you can see the history, is it narrows by the top coming down and the bottom going up. That's where all the outperformance comes from. You own more of what's underneath, you own less of what's coming down. It's simple. But you can also see how long this has been going on and how wide it's gotten. It's very much related to COVID. It's very frustrating for us in the short term, but this is what makes life very good 3 or 4 years from now. The other thing that makes life very good for the Vermont Community Foundation are choices. And this graph, I think, shows another very interesting picture, which the parallels are very intentional, which is how many publicly traded companies are there in the United States. You can see it peaked at about 8,823. That just so happens, and not surprisingly, to have been at the end of the last great technology, media, telecommunications bubble. The bubble today isn't quite as bad as it was then, although it's in the neighborhood. And then what happens, the number of companies plunged, and they plunged in part because, again, like they're doing today, public markets investors became venture capitalists without thinking about it. And a lot of companies failed back then, as you know, and that's part of the reason those numbers plunged the way they did from 2000 to 2002. The second reason they plunged and continued to plunge was things like Dodd-Frank that made it a little more difficult to be a public company in terms of reporting. And we think that was a great law, by the way. But the fact is it definitely put a little bit of a pallor on public companies. But now watch what's happening now. It's coming back, and it's coming back. One, because the same thing's happening again, which is companies that shouldn't be public are becoming public, and that's very, very worrisome. But it's also coming back because just this is the public market is still a very good way to raise capital. From our perspective, we like having more choices, and that's exactly what this gives us. It's exactly what gives the foundation what it needs to generate the kinds of returns it's historically done. So the foundation has a simple game plan. One, it's going to be messy for a while here, but we can overcome the headwinds of very high S&P valuations and very low interest rates by using diversification. So all the things that have caused us some anxiety, things like value stocks, things like non-US stocks, all those things, they become assets, and that's becoming in a very big way as we start 2022. We're getting a nice payoff from that as we speak. The second point is not to lose sight of the fact that valuation always wins in the end. It can defy gravity for a little while, but we cannot be there when basically the music stops. We need to be in the right place. And even if we're early, we're fine with that. Recognize the power of contrarian thinking. If everybody agrees with you on something, you should be nervous. And the last thing, which I think is very important, and there's one more slide, is to capitalize on the foundation's access to top investors. Having $300+ million to invest gives the Vermont Community Foundation a lot of options that most of us just don't have when we're investing smaller pools of capital. Our team's goal and our team's work is to find these firms, bring the best ideas we can to the committee and to Dan, and build a portfolio that generates the kind of success that these two pools have generated over time. So I'll just close because we're in this period of volatility. Volatility is very much our friend. That's what this graph basically says. If you're long-term oriented, you're fundamental, you're properly diversified, the volatility only just makes you a little nervous. It doesn't actually have any real financial implications for the Vermont Community Foundation. Its ability to support your philanthropy is untouched by volatility. And we're able to just literally do the things you'd expect us to do to take advantage of volatility, rebalance, upgrade the portfolio when necessary when things get out of hand in the markets, and continue to generate the strong long-term outcomes that you saw earlier. So I'm going to, I have my Crucial Partners commercial. Just a reminder, I mentioned the 71 staff members. We advise about $38 billion of capital. We are independently owned. We do not sell products, i.e. we don't have our own funds. We don't manage money specifically for anybody. So what we do for the Vermont Community Foundation is basically what we do for everybody. So let me pause there. I'll take off the commercial and love to answer any questions if you have any.
Yeah, just wondering if you might comment on the degree to which venture capital and M&As have played a role in the demise of the number of companies or the aggregation of companies.
Oh, that's a really interesting question, Ron. Yeah, clearly, yes. I don't know how much, but my view would be definitely yes. Although we're coming on the other side of that now, at least on the venture side, the growth equity side, as your question suggests, I know you know. The Vermont Community Foundation actually owns one of the reasons I'm expressing optimism about the returns going up from here in the long-term pool is the venture and growth equity we own in the portfolio. And obviously one of the ways out is exit to the public markets, and you are starting to see more and more of that happen in the pool. But yeah, I think that's a very good point. That there's a lot of capital and a lot of companies that were taken out by private equity and venture capital specifically. So excellent point. I wish I had stats for you. I'll see if I can figure out something or find something.
Dan Hudnut.
So I tuned into the call because I had looked at the end of the year performance and actually looked at Q3 of last year. I am one of those strange people who's in the midterm pool and noted in the Q3 report that the allocation to cash was closer to 40% than 10%. And then as a secondary issue, looked back to try to find out how long that condition had been persisting for. And one was not able to locate on the website prior performance and allocations that were on the website. So I guess first, just question about that allocation in the midterm pool. And second, a request for the information to be posted so that it could be reviewed for a longer period of time.
Yeah, absolutely. So there's a lot of cash in that pool that's actually now been deployed because there's a lot of cash flows in and out of that pool, Dan. So it's a great question, and so we're constantly struggling with the back and forth in that pool, but it's a very, very reasonable point, obviously.
So has the cash position, I mean, was that a 9:30 type of issue where there are a lot of ins and outs at that moment? Or is that a structural decision to maintain a high cash exposure?
There were ins and outs then. There have been more ins and outs since. So there was still quite an elevated cash position at the end of the year as well.
Does that get reflected in the fees being charged to the portfolio if it's in an unusually large cash position?
That I don't know the answer to.
And it's a good set of questions, and let me take that, to Mike, and I can work on providing the sort of cash allocation over time, looking back a little bit, and then follow up with you.
It just seems like having the allocation information on a quarterly basis available on the website would be a reasonable thing for fund holders to be able to look at and see how the funds are tracking compared to the strategies.
Thanks, Dan. Other questions?
I have one more, Dan.
Sure, Ron.
For you and Mike. We've got a lot of people on the line that are not involved, not associated directly with VCF, but have funds that are at VCF. Ours for Vermont Woodlands is relatively small compared to the total. But I wondered if individual participants that have beneficiary funds managed by VCF and you, Mike, and your firm, if they can choose to have preferential investments in one or more or fractions of the pools.
Let me say the question back to you to make sure I understand it, Ron. But essentially, if you wanted, you're asking if you wanted to have 40% of the Vermont Woodlands Fund in the long-term pool versus in 60% in the SR pool.
Is that guidance that VWA can ask VCF and investment managers to do, or are we just left to be in a general investment plan?
I think the way there's undoubtedly a way to structure a division between the pools, and it would require some architecture behind the scenes on our part, and it may get reported as independent funds, but there are fund holders who I could see a way to engineer it. The only hesitation I have is that we're in the middle of a CFO transition, so designing a more custom or bespoke allocation between multiple funds is not something I'm keen to ask our finance team to go through until we have shored up and navigated that transition. But ultimately, you could have a fund holder, whether it's an organization or an individual, open a fund and say, I want half of what I'm committing to philanthropy in the long-term pool and half in the SR pool. And that would, whether it was reported as two funds independently or one, it would be managed as one relationship. So there's a way to do that.
Thank you. Thank you, Dan.
Does that answer the question, Ron?
Yes, it does. Thank you.
Other questions? You know, there's obviously a lot going on, a lot of uncertainty around there. You know, what the future is going to look like. And, you know, I have to say Mike's enthusiasm with the price opportunities that are reflected going forward don't really mitigate my anxiety over where we are right now related to inflation. And, you know, that second to last slide reflecting the price Shiller index and the subsequent 10 years is something that you know, something that I spent a little bit a lot of time last night thinking about. And just know that we have a lot of attention on it. We have our next meeting is with the Investment Advisory Committee to the VCF for a more in-depth dive into asset allocations and, you know, plans for the year. We've got a robust team on that committee and working with Crucial in terms of navigating the oversight of the funds that are held at the VCF. So we are grateful for their partnership there and the partnership of everybody on the call today. So, other questions? We can wrap a little early if it's if people want to process, and don't hesitate to reach out either to your philanthropic advisor if you have specific questions on this stuff. Oh, I saw one hand go up. Nancy Anderson. Nancy, you're on mute right now if you want to.
Thank you. Can you hear me now?
Yes, ma'am.
So VCF has been in operation long enough to have gone through some large dips in the market that, you know, lasted for a year or 2 years. And I wonder what lessons you've learned from that, or whether you felt that you did well with what you were anticipating and the performance that you sustained during that time.
Thank you for the question. You know, what I would say, and I have to admit, I'm parroting what I've heard Deb Dabrowski observe over her 16 years, because we've had one off year. We haven't had substantial declines since I've been in the role at the VCF. But one of the two big lessons that we've learned, you know, if you looked at, as I recall, the performance of the S&P and the benchmarks recovering from the 2009 recession, when you looked at, you know, our performance post 2009 was, you know, a commitment to fortitude in the face of that uncertainty and not trying to shift strategy at the bottom of a market. I also think that was reflected in some of the near-term recovery from in the first few months after the pandemic when things were off 30 points. So as morbid as it sounds, at this point, I continue to have confidence in the investment committee's ability to reflect on the opportunities presented by Crucial when the markets are off and there's more uncertainty out there. You know, I do think the key is to take a long-term view and make you know, disciplined decisions around the asset allocations as we look forward, as opposed to being overly and unduly reactive. So those are the key lessons. And we've had some operational in terms of operational lessons in terms of the organization's how the organization has adapted in response to volatility in the market in terms of its own work and revenue. So.
Thank
If
you.
you don't mind if I add really quickly, Dan, what Dan said is spot on. And you know, the other things I think, Nancy, we've learned is that the psychology is really tough on these things. You know, when the market plunges, Dan referred to COVID. We can go back to 2008 and other times that markets have been very tough. And you know, at the time, it always feels like it's going to last a long time. And then I think what we've learned, I had a slide we put up last year. We should probably bring it back now. I hope we want to bring it back because of 2022, but which shows how fast the recoveries have been for the portfolio. So they feel like these huge, endless declines, but the recovery are very quick, which I think is a testament to the quality investments that were made pre the the decline, but two, to what Dan said, which is the idea of not being reactive, but being actually proactive. And that happened in COVID, and it actually has been happening now again. Because what we've seen is these gigantic declines in growth names outside the US, gigantic declines in smaller mid-cap tech and healthcare companies in the US have gotten out of hand. And so some of the managers in the portfolio have been calling capital from the foundation to take advantage of, really exceptionally good opportunities. And that's the beauty of having a really good team of people that you have confidence in, and can make these kinds of decisions. And I will tell you, the one manager that called capital in December, he's only done that. He's usually not accepting clients or any money in. He's done this only 3 times in the last 6 years, and every time he's done it, it was the front end of really good returns for his portfolio. So we're pretty optimistic that's going to happen again. How long it takes, who knows? But it's really what I just can't emphasize enough. What Dan said is not to be reactive, and in fact, even tougher, be proactive. Don't even just sit back and wait, because you just never know. But these opportunities can be pretty enormous.
Good, thank you.
Welcome.
I think we can wrap up the call and give Mike 5 minutes before he has to move. We're down to 1 minute before the investment committee starts. But again, I encourage everybody to reach out to their philanthropic advisors, or to me, or Stacy Fagan on the call as VP for philanthropy, and responsible for the team managing all of our respective relationships and partnerships. If there's any questions, I look forward to being able to share good news in the progress of our search for a CFO. I really feel confident in our interim plan, and in terms of managing and supporting the team in place that is this careful steward of the assets to which you've entrusted the foundation. So thank you all for being a part of the VCF, and all that your time, energy, and treasure means for the state of Vermont looking forward. So thank you.